What you call national debt is not a mistake. It is rent. For 50 years, the world has paid that rent to one landlord. The United States. Governments borrowed in dollars. Corporations saved in dollars. Traders priced oil, food, and metals in dollars. In return, America promised something simple, that the dollar would hold its value, that the system would be neutral, and that the rules would not be changed overnight. Then the rules changed. Washington discovered it could print without limit, spend without restraint, and punish its enemies by cutting them off from the dollar's plumbing. The world discovered that its savings could be frozen with a keystroke in a city it did not vote for. So behind the speeches and statistics, something began to move. Not on television. In balance sheets, in gold shipments, in contracts quietly rewritten in other currencies. On November 15th, 2024, that movement stopped being theory. In the ledgers of central banks and the internal reports at the Federal Reserve, one number began to slide in a way it never had before. The People's Bank of China and a network of entities around it started unwinding their exposure to the dollar system on a scale that no one had ever attempted. Not millions, not billions. Roughly $3 trillion of US-linked assets placed on a path out of the system they once supported. No press conference, no dramatic declaration of financial war. Just quiet selling, careful routing through intermediaries, and a deliberate reduction in how much of China's future would be chained to American promises. If you live inside the dollar world, if you work for a salary, hold a mortgage, save for retirement, or keep any part of your life in cash, you were not told about this. For most people, November 15th felt like any other day. But inside the machinery that actually determines what your money is worth, it was the start of something else. An exit. To understand why that exit matters, you have to step back from the headlines and look at the architecture you were born into. For more than half a century, the dollar has been more than a currency. It has been infrastructure. When a Brazilian company buys oil from Saudi Arabia, the invoice is in dollars. When a German factory pays for copper from Chile, the settlement is in dollars. When central banks hold reserves for safety, they largely hold U.S. treasuries, IOUs from the United States government. This structure did not appear by accident. It was built after the Second World War and then reshaped in 1971, when the U.S. detached the dollar from gold and rebuilt it on something else, energy and trust. The bargain was simple. The world would price oil in dollars and hold those dollars in U.S. assets. In return, the United States would defend the system and keep trade flowing. That bargain created the greatest financial privilege any nation has ever held. Other countries had to earn dollars by exporting goods, extracting resources, or providing services. America, at the center of the system, could simply issue them. You felt that privilege in quiet ways. In 30-year mortgages that assumed the dollar would still be the yardstick of value decades from now. In cheap imports filling shelves, paid for with paper, the rest of the world accepted without question. In government deficits that would have bankrupted smaller nations, but were absorbed by an ever-expanding market for U.S. debt. There was always a condition, even if no one said it out loud. The condition was trust. Trust that the dollar would not be debased beyond recognition. Trust that the system would not be turned into a weapon. Trust that if you built your national savings, your pension fund, your corporate reserves in dollars, those dollars would remain yours in any political weather. Over the last 2 decades, that condition has been quietly violated. Trillions printed to rescue markets, to finance wars, to fund stimulus after each crisis. Sanctions that turned access to the dollar into a geopolitical reward or punishment. Countries excluded from the payment networks that move dollars around the globe. And in 2022, one of the largest reserve holders on Earth watched its foreign assets frozen overnight. The message was impossible to miss for anyone who holds power in another capital city. Your reserves are safe until they are not. China saw this earlier than most. They studied what had happened to other countries that crossed American policy and found the same pattern each time. First critique, then sanctions, then exclusion from the plumbing of global finance. For a country that imports energy, exports goods, and holds vast piles of dollar assets, that is not an abstract risk. It is an existential one. So Beijing began to plan, not for a press release revolution, but for a managed escape. They diversified trade into other currencies. They signed bilateral agreements with Russia, Brazil, and others to bypass the dollar. They built CIPS, a payment system that could route transactions around SWIFT, and in the background, they did something even more basic. They accumulated gold. While Western balance sheets swelled with new digital dollars, China converted part of its surplus into metal that cannot be printed, sanctioned, or frozen on a server. Nobody knows the exact figure. The official number is almost certainly not the real one, but the direction is obvious. Away from paper promises, towards something physical. By November 2024, the groundwork was there. China had alternative trade routes, alternative payment rails, alternative partners, and a balance sheet that no longer had to depend on the good behavior of the U.S. Congress or the Federal Reserve. That is the context behind the quiet exit you were never meant to notice. When you hear $3 trillion, It sounds abstract, like a headline built to shock. But what moved on that day is not just a number. It is the accumulated proof of a decision that the era of trusting the dollar as the one unshakable foundation of global finance is ending. And that decision does not stay in Beijing. It travels. Through alliances like BRICS, through reserve allocation memos in central banks that never appear on the nightly news. You're not watching a bad week in the markets. You are standing at the edge of a long-built structure, just as the first supporting beams are quietly removed. The question is simpler and much colder. What happens to a country and to the people inside it when the money it issues to the world is no longer the world's default choice? Because what China began on November 15th is not an isolated act of hostility. It is the clearest sign that the rest of the world has stopped treating the dollar as a permanent fact of nature and started treating it as what it has always been: a human design, a temporary arrangement, a system with an expiry date. The rent is coming due. And for the first time in your lifetime, the landlord is being quietly, methodically replaced. In order to see how fragile this moment really is, you have to go back to the moment when the dollar was not yet an empire, just one currency among many. In 1944, as the Second World War was burning itself out, representatives from 44 nations gathered in a small New Hampshire resort called Bretton Woods. The world's economies were shattered. Europe's infrastructure lay in ruins. Currencies had collapsed. Trade had broken down. One country, and one country only, stood with its factories intact, its industry humming, and its vaults full of gold: the United States. So the delegates did something that would define the next 80 years. They anchored the world's new financial system on the dollar. Under the Bretton Woods Agreement, every currency would be tied to the dollar, and the dollar would be tied to gold at a fixed price. If you held dollars, you were effectively holding a claim on gold held in American vaults. On paper, it looked like a compromise. In practice, it made the United States the central banker to the world. But even that was not the final shape of the system you live in. That came later, when the original design began to crack. By the late 1960s, the United States was spending far more than it earned. On war, on domestic programs, on the machinery of a global empire. Dollars were flowing out faster than gold was coming in. Foreign governments started to notice that the claim and the backing no longer matched. They did what rational actors do. They began to redeem dollars for gold. Gold flowed out. Trust drained with it. On August 15th, 1971, President Richard Nixon went on television and announced what sounded like a temporary technical measure. The United States would suspend over the convertibility of dollars into gold. In that moment, the anchor that had held the system in place was cut. The dollar became a pure promise. A lesser power might have seen its currency collapse. But the United States did something else, replaced gold with oil. In the early 1970s, American officials struck a quiet deal with Saudi Arabia, the world's most influential oil producer. The terms were simple and ruthless. Saudi Arabia would agree to price and sell its oil only in US dollars. In return, the United States would provide military protection and security guarantees. Other oil producers followed the same pattern. If you wanted energy, you needed dollars. If you needed dollars, you had to earn them by exporting to the dollar world or by borrowing them on terms set by dollar institutions. This is what people mean when they talk about the petrodollar system. Oil did not just power cars and factories, it powered a global monetary order. Once that structure was in place, the dollar's role changed forever. It was no longer just a national currency, it was the ticket to participate in modern civilization. If a country wanted to buy fuel, feed its people, build its infrastructure, it needed access to dollars. That demand created something extraordinary, a built-in global market for U.S. debt. When the U.S. government ran deficits, it issued treasury bonds. Central banks, energy exporters, and corporations around the world bought those bonds, not as charity, but as the safest way to store the dollars they were forced to earn. The more the world used dollars, the more it needed a place to park them. The more it parked them, the more the United States could borrow without feeling the immediate consequences that punish other nations. This is the privilege you almost never see named in everyday life. A privilege that lets one country spend beyond its means, while everyone else labors to earn the very instrument it can create at will. For decades, that privilege looked harmless, even beneficial. U.S. deficits financed global trade. Wall Street became the center of world finance. A flood of imported goods held down consumer prices. American households could borrow cheaply, build suburbs, and live lifestyles that other nations could not easily replicate. The cost was hidden, pushed into the future as growing stacks of IOUs and assumptions about permanent trust. There was always a condition, even if no treaty spelled it out. The rest of the world would tolerate this arrangement as long as the United States behaved like a careful steward, as long as the dollar retained its value, as long as the financial system stayed neutral, a tool for trade, not a weapon in political disputes. Through inflation crises in the 1970s, through the Volcker interest rate shock, through recessions and booms, this underlying deal somehow held. It held because there was no alternative with the same depth, the same liquidity, the same web of institutions built around it. But each time Washington discovered it could stretch the system a little further, print a little more, borrow a little cheaper, use sanctions a little more aggressively, that unwritten condition eroded. The turning point did not come from a single speech or a single bill. It came from a slow accumulation of decisions that all assumed the same thing, that no matter what the United States did, the world would keep trusting the dollar because it had no choice. Wars were funded with deficits. Financial crises were met with waves of newly created money. Stimulus packages, bailouts, rescues, each one easier than the last, shielded by the comforting idea that the rest of the world will buy our debt. At the same time, the institutions that managed the plumbing of the dollar system, the Treasury, the Federal Reserve, and the network of American-dominated banks, discovered a new use for that plumbing. If every transaction in oil, food, metals, and manufactured goods passes through a handful of dollar-based channels, then those channels are not just financial infrastructure. They are leverage. Cut a bank off from those channels and you don't just inconvenience it, you paralyze its ability to pay, to import, to trade. Freeze a country's reserves held in foreign accounts and you don't just send a message, you seize the savings it thought were untouchable. What began as a neutral system slowly became something else, a hierarchy in which obedience was rewarded with access and defiance was punished with exclusion. At first, this weapon was used sparingly against nations and actors that most of the world would not sympathize with. Terrorist networks, rogue regimes, entities easy to demonize, but each use established a precedent. Each precedent planted the same question in the minds of policymakers from Moscow to Riyadh, from Brasilia to Beijing. If they can do that to them, could they one day do it to us? That question is the quiet fault line under the dollar order. It is the question that turns reserves into potential hostages. For a long time, the fear of losing access to the dollar system kept countries in line. The cost of rebellion was simply too high. But fear cuts both ways. When a country becomes big enough, powerful enough, and sufficiently integrated with other dissatisfied players, the fear of staying inside a weaponized system can outweigh the fear of leaving it. That is where China's story diverges from every smaller nation that faced sanctions or isolation before. China is not a marginal economy that can be bullied into submission without consequences. It is the manufacturing hub of the world, a central node in global supply chains, a major creditor, and a rising military power. When a country like that looks at a system where its savings can be frozen and its trade cut off at the press of a button, the conclusion is not subtle. It must find or build a way out. The $3 trillion that began to leave on November 15th are not just numbers shifting on a screen. They are the results of a calculation made over years. How much longer can we afford to leave our future inside a system that someone else controls? For decades, America thought the answer was forever. That as long as oil was priced in dollars and global trade settled in dollars, no one would dare to move. But the day you treat dependence as permanence is the day your strength becomes your vulnerability. The dollar did not become dominant by accident. It was engineered into place with treaties, deals, and a relentless extension of American power. Now, in boardrooms and ministries far from Washington, that same engineering is being applied in reverse. The empire of paper is still standing. But the most important players inside it have quietly stopped believing it can never fall. The first sign was not a headline, it was a pattern. Countries that had never questioned the dollar began to ask for options. Not in public speeches, but in closed meetings, in quiet memoranda, in trial transactions too small for the average newsfeed to notice. A sanctioned bank here, a frozen reserve there, an oil cargo rerouted because a switch in New York said no. This is how money becomes a weapon. Not with explosions, but with silence. You do not see the moment a payment is blocked. You do not hear the sound a seized account makes. Somewhere, a trade that should have cleared simply does not. A shipment is delayed. A deal collapses. An economy that thought it had a lifeline suddenly discovers that the rope leads back to a foreign capital. For the officials whose job is to keep their countries running, this is not a theoretical debate about democracy or values. It is a simple calculation. Can we continue to base our survival on a system that someone else can disable? The more Washington leaned on financial sanctions, the clearer the answer became. The dollar plumbing that once looked like neutral infrastructure now looked like a series of valves controlled by one government. Access could be opened or closed. Pressure could be increased or reduced. A tool built to move value became a tool to enforce obedience. The logic behind this was understandable. Why send soldiers when you can freeze accounts? Why risk lives when you can cut off credit? For policymakers, the dollar weapon was elegant, clean, bloodless. For everyone else, it was a warning. If your reserves, your trade, your banking system can be throttled by someone else's policy choices, then sooner or later, you must either accept permanent subordination or find a way around the valves. The smaller nations complained quietly and adapted as best they could. They held just enough dollars to survive, looked for alternative partners when they could, and absorbed the costs. They had little choice. China is not a small nation. When Chinese officials watched reserves being frozen and systems being used as levers, they did not see isolated punishments. They saw rehearsals. They asked a different question. What would happen if a future conflict made them the target? For a country that imports energy on a massive scale, depends on global trade, and holds great stores of dollar assets, the cost of waiting to find out is unacceptable. So they began to build a different escape route. It did not start with announcements. It started with infrastructure. China created its own cross-border payment system, CIPS, a network capable of settling trade in yuan without passing through the traditional dollar-dominated channels. At first, its volumes were modest. It did not need to rival SWIFT overnight. It only needed to exist. They nurtured the Shanghai Gold Exchange into a major hub for physical gold trading, shifting part of the metal's pricing power from Western financial centers to Chinese soil. At the same time, they encouraged domestic banks and state entities to acquire gold steadily, quietly, transforming surplus dollars into something that could outlast any sanction. They launched the Belt and Road Initiative, a vast web of infrastructure projects stretching across Asia, Africa, and parts of Europe. On the surface, it was about ports, railways, and power plants. At a deeper level, it was about something else: dependencies. When a country owes China for its ports and power, when its trade routes run through Chinese-built rail, when its digital networks depend on Chinese technology, the relationship is no longer transactional. It becomes structural. In a future where trade shifts away from the dollar, these dependencies can be priced, settled, and rolled over in yuan or in any new unit China chooses to promote. Meanwhile, China and its partners crafted a political framework to legitimize this shift: BRICS. What began as an acronym became an alliance of major emerging economies, Brazil, Russia, India, China, South Africa, tied together by one shared instinct: discomfort with a world where one currency defines the rules. Then the circle widened. Saudi Arabia, the United Arab Emirates, Egypt, Iran, and others were invited to join or align. Energy producers, population giants, key regional powers, all gradually drawn into a bloc whose central theme is simple: reduce dependence on the dollar. Bilateral deals followed. China and Russia moved most of their trade into rubles and yuan. Agreements with Brazil allowed settlement in local currencies. Currency swap lines multiplied, letting central banks support each other's liquidity without touching the dollar at all. Each of these steps, taken alone, could be dismissed as a minor adjustment. Together, they form a new map. On that map, the dollar is no longer the only route between points. There are parallel roads, narrow now but widening every year, where trade can move, reserves can be held, and value can be stored without asking permission from Washington. Yet even with this alternative network in place, one question remained unsolved: trust. If the world had grown skeptical of a dollar backed only by political promises, why should it trust another paper currency issued by another powerful government? China's answer was not delivered in words. It was delivered in tons. Gold moved in. Quietly, consistently. Officially, China reports a modest figure. Unofficially, analysts estimate far more. A strategic hoard accumulated through domestic mining, long-term imports, and opaque flows that never appear on world-visible ledgers. Gold does not pay interest. It does not submit to a central bank's wish for higher GDP. It simply exists, a dense record of energy and time extracted from the earth. For 5,000 years, people have trusted it when they could trust nothing else. When you combine a rising trade network, an alternative payment system, a coalition of states seeking monetary autonomy, and a vast stockpile of gold, you get something new: the credible possibility of another anchor. Not necessarily a full return to a gold standard, but a partial backing. A signal to markets that a future yuan, or a BRICS unit, might be tied to something more solid than the promise of future growth. That signal does not need to be announced today. In some ways, it is more powerful as a looming possibility than as a formal decree. The mere expectation that China could one day link its money to gold changes the calculation for central banks that are already overexposed to dollars. If you suspect that the issuer of the next reserve currency will anchor its money to metal while the current one anchors it to politics, where do you want your long-term savings to sit? That is the background to the $3 trillion. Before you can walk away from a system, you have to know where you are walking to. By the time China began its quiet exit from U.S. assets, it had spent more than a decade constructing the destination. The move out of dollars is not a leap into the dark. It is a step onto a platform Beijing has been assembling brick by brick, while most of the world assumed nothing would ever really change. From the outside, the dollar still looks unshaken. It remains the unit in which most global trade is invoiced, the core holding in central bank reserves, the reference point for markets everywhere. But if you look underneath, at the flows instead of the headlines, a different picture emerges, one in which China and its partners are no longer building their future on the assumption that the dollar S reign is eternal. In that picture, November 15th is not a beginning. It is an inflection point, the moment a strategy moves from preparation to execution. And what happens next does not stay in spreadsheets or in the halls of central banks. It spills into the price of everything you touch. When a country begins to step away from the dollar, it is not just a political insult. It is a change in the way demand flows into the core of the American financial system. For decades, the United States has relied on a simple pattern. The world earns dollars, then sends those dollars back by buying U.S. debt. The more others wanted to save in dollars, the cheaper it became for America to borrow. That loop is what kept interest rates low even as deficits climbed into the trillions. It is what allowed governments to roll over old debt with new debt at manageable costs. It is what let households finance 30-year mortgages and long-term projects at rates that assumed stability as a permanent feature of life. When a major holder like China chooses to reduce its exposure, that loop weakens. When others follow, it begins to break. The mechanics are straightforward and merciless. If foreign central banks stop buying as many U.S. treasuries, or worse, start selling them, the price of those bonds falls. When bond prices fall, their yields rise. Those yields are not an abstract statistic. They influence the rate at which your government, your employer, and you yourself can borrow. The entire architecture of modern American life is built on the assumption that the cost of borrowing will remain within a certain band. Mortgages, corporate loans, state and municipal bonds, federal deficits, all of it depends on a market willing to absorb U.S. debt at low yields. When the marginal buyers of that debt decide they have enough exposure to the dollar, the United States can still sell its bonds. But it has to pay more to do it. Higher yields on treasuries mean higher rates on everything that references them. Mortgage rates climb, car loans become more expensive, credit card interest that already feels predatory begins to look impossible. The line from a quiet bond sell-off to a family struggling with a mortgage payment is not intuitive, but it is direct. In a world where demand for dollar assets is no longer infinite, the United States faces a choice it has not had to confront for generations. Either accept painful rates at home to keep attracting capital or print even more to cover the gap and risk accelerating the very decline in trust it is trying to prevent. Neither path is gentle. If policymakers choose to defend the dollar's value with high interest rates, they squeeze their own population. Debt-laden households and businesses face a wall of refinancing at levels they cannot sustain. Housing markets that were built on the assumption of cheap credit begin to crack. Marginal firms, dependent on rolling short-term debt, fail. Unemployment rises. If they choose instead to lean on the printing press, keeping rates lower than the market would naturally set, they signal to the world that preserving domestic comfort matters more than preserving the currency's purchasing power. For foreign holders already anxious about their exposure, this is confirmation. It invites faster diversification out of dollars, not confidence. Either way, the anchor that kept the system stable, the assumption that the world would always want more dollars, is gone. There's another layer to this. When the dollar finally loses its status as the singular reserve currency, the trillions parked offshore do not simply disappear. They seek a home, they move, they return. For years, those dollars have lived in the balance sheets of foreign central banks, sovereign wealth funds, and multinational corporations. They have sat in accounts abroad, circulating in global trade, not bidding directly for goods and services in American neighborhoods. As trust fades and alternatives rise, those holders have two choices. Exchange their dollars for other assets while they still can, or bring them home to buy what remains relatively stable: land, companies, hard goods. In both cases, the effect is the same: a flood of claims chasing a limited stock of real things. That is how inflation stops being a statistic you argue about on television and becomes a daily reality you cannot escape. Prices begin to move faster than wages. The currency in which you are paid loses purchasing power quicker than your contract can adjust. Groceries, fuel, rent, medical care all rise in a series of jolts rather than a smooth, predictable line. At mild levels, inflation is an annoyance. At high levels, it eats savings. At extreme levels, it changes behavior. People spend as soon as they are paid because waiting is punished. Long-term planning dissolves. No reserve currency can be in crisis without reshaping the way its citizens think about time itself. A country that has built its standard of living on the ability to import more than it exports faces another reckoning in such a transition. For decades, Americans have consumed more than they produced. And the gap has been covered by the willingness of the rest of the world to accept dollars in return. Ships left foreign ports full of goods and arrived in American ports to be traded for paper claims. When the dollar's dominance fades, that arrangement is no longer sustainable. The United States cannot simply send digits and expect the same quantity of real goods to return. To maintain access to imports at anything like current levels, it must offer something of genuine value in exchange. Commodities, advanced manufacturing, services others cannot easily replace. Rebuilding an economy around production rather than consumption is not impossible, but it cannot be done overnight. It requires investment, time, and sacrifices that no democratic system finds easy to coordinate. While that adjustment unfolds, the lived experience is simple. Fewer cheap goods, higher prices for essentials, and a standard of living that feels as if it is being pulled slowly downward. Meanwhile, the federal government itself stands on top of a mountain of obligations. Decades of deficits have produced a national debt that already exceeds $30 trillion and continues to grow. The promise is embedded in entitlement programs, pensions, medical benefits, social support. Assume that future governments will always be able to borrow at manageable rates to cover any gaps. Take away the foreign demand that kept those borrowing costs low, and the arithmetic changes rapidly. To service the existing debt at higher interest rates, Washington must either devote a much larger share of its budget to payments, cut spending elsewhere, increase taxes dramatically, or some combination of all three. Each path is politically explosive. Each invites its own form of instability. In such a scenario, the temptation to resolve the tension by letting inflation do the work, to erode the real value of the debt while pretending to honor it in nominal terms, is enormous, but inflation does not quietly eat only government liabilities. It erodes wages, savings, and private contracts along with them. It punishes prudence and rewards speed. It destabilizes precisely the class of people who had nothing to do with designing the system in the first place. By the time a reserve currency is visibly in trouble, the most connected players have already acted. They do not wait for official confirmation. They read the flows. They attend the meetings where the unsanitized data is presented. They see the shift in central bank reserves months or years before it filters into public awareness. While the majority debates whether there's even a problem, those with early access have already moved portions of their wealth into assets that lie outside the most vulnerable layer of the system. They accumulate real estate in jurisdictions less exposed to the crisis. They buy stakes in companies that produce essentials, energy, food, raw materials. They acquire gold not as a speculation, but as insurance. They diversify into other currencies and legal systems, making sure that no single government can freeze or tax everything they own with one decision. By the time ordinary savers see the headlines, the best exits are already crowded. Prices of the safest assets have risen. Access has narrowed. This is the structural cruelty of a monetary order in transition. Information arrives in layers, and each layer determines who bears the brunt of the adjustment. The people who trusted the system the longest, who worked, saved, and held their wealth in the form recommended to them by institutions, are the ones most exposed when that system reprices. They are told, after the fact, that no one could have seen it coming, even as the graphs and memos in some offices told the story years in advance. None of this is unique to the dollar. When the British pound ceded its role as the world's reserve currency in the 20th century, the mechanics were similar, even if the scale was smaller. Wars, debts, changing industrial balances, and new competitors shifted the center of gravity toward the United States. In each case, the decline of a reserve currency was presented as unthinkable until it was suddenly obvious. The old unit did not vanish. It simply lost the special status that once insulated its issuer from the full consequences of its choices. The dollar is now approaching that same cliff. The part that is often left unsaid is that there is no painless way to step back from it. Global finance is a network. Every obligation is someone else's asset. Every promise rests on another promise somewhere else in the chain. If the world tried to reset cleanly, to cancel debts, re-anchor currencies, redistribute claims, entire sectors of that network would fail. Banks would be insolvent. Pension funds would be crippled. Contracts written on the assumption of stable money would be broken. In theory, there are ways to design new systems. In practice, any attempt large enough to matter would trigger the very panic it is meant to prevent. That is the trap. The dollar system, as it exists, cannot continue forever. Its internal logic, ever-rising debt, ever greater reliance on trust, ever-frequent use of sanctions, has produced the backlash that is now eroding it. But the world is so entangled in that system that a clean escape is impossible. Any movement big enough to free one set of actors threatens to destabilize others. So the unwinding happens gradually, in phases, and in layers that most people only perceive as isolated events. A crisis here, a currency shock there, a wave of inflation, an unexplained spike in rates, a sudden change in trade patterns. From ground level, it looks chaotic and random. From above, it is the slow rearrangement of power. Where does that leave you, the individual living through it? You cannot redesign the system. You cannot veto the choices of central banks or the strategies of governments. You are not invited to the meetings where new reserve arrangements are sketched, but you are not powerless. You can choose how much of your life sits in the most fragile layer of this architecture. Unsecured promises denominated in a currency whose special status is eroding. For generations, the default strategy was simple. Hold cash, keep savings in domestic banks, buy domestic bonds, trust domestic institutions. In a world where the reserve currency was expanding and the system was reasonably stable, that worked well enough. In a world where the core is weakening, a different instinct is required. Wealth that never leaves the dollar, never leaves bank deposits, bonds, and financial products tied directly to the U.S. currency remains fully exposed to whatever path policymakers choose. High rates and recession, or printing and inflation, or a volatile mix of both. Wealth that takes other forms behaves differently. A piece of land does not care what unit you measure it in. A productive business that feeds people, powers homes, or extracts vital materials retains value across monetary regimes. A bar of gold or a handful of silver coins do not adjust to policy speeches. They adjust to reality. Even holding claims in other currencies, especially in jurisdictions less entangled with the dollar order, spreads risk instead of concentrating it. It is not about fleeing. It is about refusing to let a single system determine the fate of everything you have worked for. Beyond assets, there is something harder to quantify and impossible to confiscate. What you can actually do. Skills, relationships, knowledge of how to create value in the physical world. These matter more, not less, when money itself is in question. When supply chains strain and prices swing, communities that can grow food, repair infrastructure, provide services, and coordinate locally are less dependent on the smooth functioning of a distant financial machine. You cannot stop a reserve currency from declining. You can decide whether you stand directly under it as it falls. The most dangerous place to be in this kind of transition is not at the very bottom or the very top. It is in the comfortable middle that believes, until the last minute, that things will return to how they were. That belief is reinforced by the institutions whose legitimacy depends on it. Mainstream media outlets, governments, and large financial firms all have strong incentives to project stability. To acknowledge openly that the dollar's era as the singular reserve currency is ending would be to admit that many of their assurances from previous decades were built on a temporary advantage, not a permanent law of nature. So they speak instead in fragments. They acknowledge volatility, unexpected inflation, geopolitical tensions. They discuss BRICS and de-dollarization as side stories, not as the core narrative. They do not lie about the numbers. The numbers are public. The share of reserves held in dollars is declining. The share of trade settled in other currencies is rising. Gold purchases by central banks have hit multi-decade highs. But the meaning of those numbers is softened, diluted, spread out over years of commentary. The structural story, the story you are living inside, is rarely told plainly. The result is a population caught between data it does not fully understand and narratives that are designed not to alarm. Yet the architecture does not care about comfort. It responds to choices. China's choice to reduce its exposure to the dollar is one such choice. The choices of other nations to diversify reserves, to sign non-dollar trade agreements, to accumulate gold are others. Each one is a vote in a quiet election about what will count as money in the decades ahead. You cannot cast a ballot in that election. But you can recognize that it is happening and adjust your own behavior accordingly. When you shift part of your savings into assets that do not depend on a single currency, IS privilege, when you learn to create value that travels across borders and regimes, when you refuse to assume that what worked in your parents' era will work in yours, you are doing something subtle but important. You are stepping out of the role the system assigned you. You stop being just a passive holder of the dominant currency and become an active manager of your own exposure to it. That will not change the trajectory of the dollar. It will change how much of that trajectory defines your future. The $3 trillion that began to move on November 15th is a signal. It is the clearest one you're likely to get. A major power has decided that the old bargain, the one that said the dollar would be the center of the financial universe, indefinitely is no longer acceptable. The system built on that bargain will not collapse in a single day. It will unwind in stages that feel, at first, like ordinary crises. A spike in rates, a wave of inflation, a sudden shift in trade flows, a new currency announced by a coalition you barely heard about. Each event will be presented as separate. Together, they are chapters of the same story, the end of a monetary empire and the birth of something that has not yet fully taken shape. You were never meant to see this architecture clearly. You were meant to live inside it, to work, to save, to believe that national debt was an abstract concern and that the value of your money was guaranteed by forces beyond your understanding. But once you see it, once you understand how the reserve privilege was built, how it was abused, and how others are now systematically exiting it, you cannot unsee it. You recognize that what is often described as a collapse is, for others, a strategy. You understand that what looks like chaos from the surface is, in some rooms, a plan carried out over years. There is no comforting ending here. No guarantee that a new system will be fairer, or that the next reserve currency will be gentler than the last. What you gain is not safety, but clarity. Clarity that the dollar's dominance was never a law of nature. Clarity that its decline is not an accident. Clarity that your role is not to wait for someone else to fix it, but to decide how much of your life you are willing to leave exposed to a structure whose builders are already walking away. What you call national debt is not a mistake. It is rent on a fading order. The landlords are changing. The terms are changing. The only real question left is whether you change with them or let the old story claim more of your future than it has to.